I'm Howie Lim. This is Money Hacks by the Business Times. Recently, private residential property transactions with short holding periods, especially sub-sales of uncompleted units, have sharply increased. In fact, we earlier reported in March 2024 that sub-sale volume rose for a second year in 2023 to their highest levels since 2013. To curb rising speculative buying in Singapore's residential property market, the government increased the seller's stamp duty rates by 4 percentage points and extended the holding period for SSD from 3 to 4 years. Dun dun dun. Some analysts are calling it a light touch measure, which shouldn't affect genuine home buyers and long-term investors, but how might it affect your property investing journey? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And helping us out today, Eugene Lim, Key Executive Officer of ERA.
Hi, thank you for having me on the show.
Eugene, let's get straight into it. How will the increased seller's stamp duty and extended holding period specifically impact the resale market for properties purchased prior to these changes?
So understandably, this recalibration back to a 4-year holding period has caused some concern and also some misunderstanding. It is important to note that the changes took effect on 4th July this year, and properties that were bought prior to this date are not subjected to the 4-year holding period. If you have bought your property before 4th July, then your holding period is just 3 years. For those that have bought on or after 4th of July, you will have to hold them for 4 years. Otherwise, you'll be subjected to the seller's stamp duty.
And given the forecast for gentler mortgage rates by late 2025 and the upcoming supply wave of new private launches, what should home buyers maybe be looking out for in order to know when to buy?
So we get that question quite a lot. Certain buyers, they are always trying to time the market. Now, timing the market is very difficult to do. You're trying to enter at a low point and exit at a high point. So what is a low point? What is a high point? It's very hard to predict. Let me give you an example. In a rising market, some buyers decide to wait because they think that if I wait longer, then prices may come down, then I can enter the market at a lower point. But in a new launch, developers price their projects according to the land cost plus construction cost plus a profit margin. And in today's context, to move sales, they don't price it too high. High to some people, but in terms of trying to make a decent profit, they're actually not making very high profit in the beginning. So at that new launch, some people say that, price is high. I decide to wait it out. But however, the project that was launched sold very well. When this happens, developer who had priced it attractively at the beginning stage will start to increase price for the remaining units progressively as we go on. So you find that maybe about 3 to 4 years after the launch, where the project is near to completion, that is where some people will try to exit the market. And you find that prices by then, if you buy in the resale market or sub-sale market, you could have gone up by maybe 20 to 30% or sometimes even more depending on market conditions. And then what will happen to future launches, say in the same locality? So it is never easy to time the market. Rather, the strategy that many astute home buyers have been using is what time in the market, buy and wait. There's always a ready pool of buyers to buy what we call newly completed projects because these are people who have sold their house and they're actually looking for a ready to move in home in the resale market. And there's also a steady pool of investors who are buying properties that's ready to rent out. So that's why an easier strategy is time in the market.
All right. Such nags you guys are. So when it comes to property, to the uninitiated, it always seems to be about location. Is that still true? I mean, how much can location really factor in a small place like Singapore? Are there other factors which could influence a property's long-term capital appreciation?
In Singapore, we are very fortunate that our government releases information ahead of time. Draft 2025 master plan. Why are we looking at a master plan? Because in property, besides what we talk about location, it's about the growth story of the area. The growth story actually helps you to resell your property when the time comes. It's a medium to longer term holding, and you want to know that I want to resell my property, what will be the location be like? Will it be better than today? So you should always look to the master plan, which would actually is a crystal ball that tells you what the locale will be like in the future. In the new master plan that is coming up 2025, some of the key areas that we could consider, because this will transform the location over the next 10 to 15 years. One area that we are familiar with is the One North Dover area. Existing, it's a media center, it is the biomedical research, and most people who buy properties around there buy them to rent it out. So you will have good quality tenants who work in these locations. There are also many people who work there themselves, so they buy properties to be near their places of work. Now, what's coming up? More homes are being added because the government feels that the work, live, and play concept is a proven concept. They believe that with quality developments coming up, they want to add more homes. And so if you were to buy a current home in the location, in the future, you could see price appreciation because future land that is going to be put there for sale, definitely the price will be higher than today.
Hold that thought, Eugene. Although I never knew in small Singapore people would actually buy homes near their workplace, especially since our transport system's not bad. Anyway, more with Eugene Lim from ERA in a moment about your property investment journey.
Breaking news from the Business Times podcast team.
Hi guys, this is Emily Liu, your host of Market Focus Daily. I've got some great news. Come July, Market Focus is getting bigger. I'll be bringing in market and investment experts into the studio to share analysis and opinions on what moved the markets and what to look out for in the week ahead. Every Friday, starting on July 4th.
Look out for Market Focus Weekly from the Business Times or wherever you get your podcasts.
And now, back to Money Hacks from the Business Times.
Welcome back. Okay, Eugene, more locations with a good growth story. You started with the One North Dover area.
Another interesting place will be Marina South. So actually government has significant plans for the area. It's an expansion of the CBD. So by then you will probably see more developments coming up. So again, if you buy into a development there's only one and only development there called One Marina Gardens, you will probably be a first mover advantage, enjoy capital gain. So other areas like Kallang, where the sports hub is, Kallang Alive, they're going to rejuvenate the area. More facilities, more infrastructure coming up. And therefore, if you own homes in and around there, you expect to enjoy the fruits when all this infrastructure is put into place. Further downstream, Long Island, very long stretch in the East Coast area, still in the planning stages. We may not materialize in our lifetime. They're building literally an island because of the rising sea levels. Put housing, buildings, so you're building an extension of the current East Coast area, so you can expect more properties with sea view. Bukit Timah, Turf City area, it's going to be an up-and-coming residential area, more HDB and private homes over the next 10, 15 years. Patterson and Newton, Orchard Road area, some people say it's becoming very dated, time to rejuvenate the area. So the Patterson-Newton area is part of this scheme to rejuvenate the Orchard Road area. So they're adding more residential, more infrastructure, more buildings to it. So again, if you buy something today, you must be confident of the growth story in their location. That growth story will actually help you in the future preserve your resale value or even enhance the resale value of your property.
Oh, that sounds promising. But considering the market's slower trading cycle and buy and hold nature, what are the potential risks for investors who maybe need to liquidate their assets within a shorter time frame than the typical holding period?
Very interesting is that over the last 20 years, if you map out the property cycle in Singapore, there are ups and downs. But the overall trend over the last 30 years is that property prices will trend upwards. Now that trend line, it's a gentle line. So you do not expect buy today, sell tomorrow and make a lot of money. It's a managed market in Singapore because government plays a very active role in ensuring that while property prices increase, they keep pace with rising income levels and also population growth, so that nobody is technically priced out of the market because of speculation or overinvestment. Having said that, there are risks for properties investment, just like any other investment. So the whole idea to mitigate this risk is that when you buy any property, you must always have a long-term plan. That means don't buy with the intention of, I want to sell in the earliest exit point. In your property holding journey, say over 5-10 years, there are multiple exit points. But what if the market conditions at that point in time is not ideal? If that happens, and property prices in Singapore in the past has gone down primarily because of several things. Number one, economic conditions. When we enter a recession, people lose jobs, pace of economy slows down. So understandably, the whole property market will slow down. Or an external crisis that happens outside of Singapore that has nothing to do with us, but it impacts us because we are an open economy. But if we look at historical anecdotes, at the end of the day, if you can hold out for this period of time where property prices are going down, it will come back up again. And the next upswing or the next peak will be higher than the previous peak. In simple ways, don't be caught with your pants down. I mean, you buy something that you can hold in the event property market is trending down, you have to hold it there and wait it out for the price to go up again. So people who lose money in property investment are typically those that plan it too tightly, no excess capacity, they over-gear themselves, and they have to exit, unfortunately, at a time where the market is down.
Oh dear. What about HDB upgraders though? I imagine they'd need more specific financial calculations and considerations so they don't, over-leverage themselves.
So for HDB upgraders, there's actually two strategies. For those that can afford it, they can actually buy a private property without having to sell their HDB flat. And I put a big if there, if they can afford it. Why? Because if you hold on to your HDB and you buy a private property before you sell your HDB, or you're not selling your HDB, then you will have to pay additional buyer stamp duty. So the other thing that you have to take note of is that financing will be lower because you have an existing loan on your HDB flat that you have not yet cleared out. So the maximum loan you can get for your private property is 45%, not the 75%. So it means the other part of it will be cash money, basically your own quantum. And thirdly, CPF restriction. Your CPF has been used for the first property. And if you buy second property, you want to use your CPF, then CPF requires you to have the basic retirement sum already stashed in your CPF before you can buy the second property and use your CPF to pay for it, even though you have not reached 55 years old. Then lastly, of course, higher holding costs. Because now you hold two properties, the second property will not be taxed at owner-occupied rate. So the property tax for your second property starts from 12% up to 36%, compared to starting from 4% for an owner-occupied property. So for most HDB upgraders, the logical route will be to sell first then buy. That's why in today's context, we are seeing quite a fair bit of home buyers in the private property market coming from the HDB market. Why? Because HDB prices today has gone up over the years. It's continued to trend up, even though the amount of increase is slowing down. But if you bought a flat 5-10 years ago and you sell today, you will make a profit. And the profit that you make actually helps to pay for the down payment of your private property. And if you sell your flat first, you don't have to be subjected to ABSD, and you can have a higher quantum loan back to normal 75%. And your CPF, there's no more restriction because if you sell your flat, you pay back the CPF to your CPF, you can use all your CPF money again. So it's a very logical route for most HDB upgraders. They sell first, then buy. It's an inconvenient route. They sell the flat and they actually rent a place. That's why they buy new homes. They buy new projects. There's a waiting period of 3 to 4 years for the construction. During that time, they will rent a place. Then if I rent a place, wouldn't that be money outflow? But the point is this, if you do a simple calculation, you find that the rental pay over the construction period of your new home is probably still cheaper than the additional buyer stamp duty of 20% on the price of your new home.
That seems excessive. Surely there's a better way.
There's also another group of people who sell the HDB flat and they buy newly completed projects ready to move in. So I don't have to rent a place for that 3 to 4 years. That's why the market is pretty active in terms of HDB upgraders. there's another group of people who are upgrading from HDB. Instead of buying private property, they buy executive condos, ECs. So executive condos are a hybrid between HDB and private condo. The look and feel is exactly the same as private condo, except they come with eligibility criteria. So for HDB owners who are eligible, means they meet the income ceiling criteria, they can buy executive condos. So executive condos are just like private property, look and feel, and 5 years after you have stayed in, you can actually sell the property in the resale market just like any private condo. And the good thing about ECs is it's the only type of private property that you don't have to pay AVSD, because at the end of the day, you can only own the EC, you cannot own the HDB. When to collect your key for the EC, you have to sell away the HDB. We do see a lot of people also upgrade from HDB to EC, which is cheaper than private, and avoid paying the ABSD.
I wish we had more time. Thank you, Eugene, for your insights today.
Thank you.
I'm Howie Lim, and this has been Money Hacks by the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.